Um, so today one of my friend asked me to check whether this plan from LIC is good or not. So the plan is 945 Jeevan Uma. He's a salaried guy, similar to my age, 28, and his family was pushing him to invest in LICs. And so he just came to me and asked me whether this is a good investment or not. So basically, this breaks down how it is possible to invest and what are the sum assured, how the tenure is. Uh, but like it is summarized well at the bottom. So let's just walk through it. So they are basically asking you to pay the premium for 20 years from age 28 to 47. So basically, this is your premium. First year it is 2.6 lakhs, and then it will be 255. Moving ahead for rest of the 19. So total you will pay. Basically, this will be your investment, and this 3,78,000 as per this document you will get every year from age 48 till 99. So basically you are investing till 47, and then from next year you will start getting this premium up to age 99. And then there is a insurance part to it, which is basically natural case shown above table. For example, in case of death at 33, you will get around 64 lakhs. Then if that is an accidental death, then you will get basically 1.1 cr roughly. And at the age of 100, so basically you're getting something bonus in return because you did not utilize this in case of any mishap, or in case of any accident you did not utilize this term insurance. So basically they are giving you back this 42 lakhs roughly. And then they explain you age cases or in between cases at the age of 60, 70, and 80. And then they are saying that, hey, at the age of 47 or 68, you can take loan up to this level because you have invested this much amount and you already have a term insurance, or against that you can take this much amount of loan at uh, this many at these ages. So we will just ignore this loan part to make the thing simple and to compare this plan. We'll just look at first the term insurance part, or which is the accidental death part, and basically what kind of returns they are giving in terms of internal rate of return, or in calculations that is termed as XIRR. I'll show you how to calculate and how it is taken care. So we'll just compare the investment and term insurance part, and what are the other options if this is a good policy. If not, then what we can do to get a better investment, uh, comparing with same values. So let's have an Excel. So I have just prepared a simple Excel. So basically, I'm running my premium numbers 1 to 20. This is my age, and basically date I have taken just as a 1st of January. That we'll consider just for the sake. And these are the 20 premiums that I have marked in yellow. Basically, you will be paying those premiums. So I've just highlighted. So to make it simple, I'm just going to take 255 as the whole premium paid for 20 years. So not complicating by, because they have mentioned that in first year. Okay, let me just take this as. So in first year you paid this much amount, and from second year you are paying 2.55 for 19. So I just mark these values as negative values because you are paying the premium. So you are negating it from your bank accounts. And from age 48, as per this document, you will start receiving 3,78,000, and your total investment in 20 years is basically 51 lakhs. If you can go here, just sum it up, you will see at right bottom it is 51 lakhs roughly. So now I will paste this value to all the 90 till age 100. I have pasted this value. This summation, this value is positive because you are getting the amount. And then there was a last part that you will receive this 3,78,000 from age 48 till 99, and age 100 if any, like your, if you any like any mishap doesn't happen to you and you are well healthy at age 100, then you will receive this premium of 41 lakhs. So here we are just considering, oh sorry, this is 4 crore, sorry. This is a well amount, so great amount to have, but not a age 100. So so I have just considered 1st January as the birth date as well as the investment date to make things much more simpler. So basically XIRR is the internal rate of return. So basically what is the percentage of returns that we are getting. So it is very simple, just type in XIRR, uh, then in open the brackets. So Google Sheet or Excel will guide you. So it is asking you to select all the cash flows. That was the reason I selected negative values when you are paying and positive values when you are receiving the payment. So my D column is basically money flow. So the cash flow, I'll just go ahead and select it. I hope everyone knows, once you select the first cell, you just hit Control Shift and down arrow and you will select the rest of the things automatically. So after cash flow, it is asking me cash flow dates, at what date you are investing or taking out that amount. Like I said, to keep the year constant in between all the flows, I have just considered 1st of January, and I've selected all the dates again. And now it is just a rate guess, how, like what percentage of rate of return that we are getting. So it is just asking us to guess. You can have your guesses now, or you can just leave it blank here. Or let's say we assume the bank FD returns are 7%, 8%. So let's just assume 7. So I entered the value 7. So 7 is basically our guess, but the system will calculate and tell us that, hey, this is the rate of return that you are getting. Okay, this should be 7%. Okay, so the system has given us a 0.054, so which is basically 5% of return. In this case, so it is, let me just write it down here. Returns till age 100. Now, in this case, you are assuming you will be healthy enough till age 100, because at the age 100, you are receiving 4 crores. So that like bumps your 5.4 rate, the rate of returns much higher. But let's assume, I think like I, looking at my lifestyle, I will be good enough if I can reach till age 80. So I'll be considering the same values, like calculating the same thing, XIRR. So now I have to select the cash flows till my age is 80, right? So this is column row 54. You can see this is 53 serial number or the premium number, age is 80 in years 2075. So I've selected all the cash flows. Now it's time for me to select the dates. So I'll just type in here 54. Now you can see both the rows are matching. And now my guess is basically, of course, it will be less than 5.4, but let's just leave it blank for now and you will see the difference. Okay, great. So now basically this plan is giving you uh, this plan is basically giving you returns of 3.55. If I go, let me just check FD rates in India. So which is 4.6 long term. Let me just go back and check. So this starts from 3, but this is for 7 days. Of course, you're doing for more than an year. So basically your returns is 6.75. So definitely this plan is not a good investment tool, we can say, based on this calculations, right? But we are missing a part where my plan was saying that if anything happens to you, they will provide me 63 lakhs, right? If anything happens in between from age 33 or any time, so this is how LIC works. So anything happens to me, so they will support my family by giving that agreed amount, which is in this plan it is 60 lakhs roughly. But to cover this is usually we call it as a term insurance. So there are certain term insurance uh, that will help me to counterbalance this. If I'm not investing in this, or if I'm comparing a good investment compared to this LIC policy, I need two important things. One is basically my term insurance. If anything happens to me, uh, so it should be able to provide 61 lakhs. And the second important thing is basically investment tool, which is higher than 6% of returns, right? So these are two important things that I need to tackle. Then only I can say that, okay, whatever tool I have defined, it satisfies these two conditions. And then only we can say that, okay, we have found a better tool to invest compared to this LIC plan. So let's tackle this term insurance part first. So there are definitely good term insurance. So you can just, if you want to search for a better one as per your needs, you can just go to Policy Bazaar. You can go here, term insurance. So I have already filled up. So I just took a birthday to meet 28 years. So I'm getting a free quotes. Okay, now I'll be getting too many calls from now. So here you can filter out whatever your requirements are. So like I said, to compare one-to-one match, I have selected till 100 years. Then basically I have selected 1 CR. You can, but the LIC was giving me 65 lakhs. So if I select 65, I'll get the premiums will decrease. So now this is a monthly premium, and basically there will be a yearly premium as well. But let's consider monthly, which are on a higher side comparatively. But let's consider 60. But instead of 65, I'll just take it as 1 CR just to simplify things. And of course, we want to do better uh, than this premium. So what we are going to do is basically make something higher values, better gains compared to this LIC plan, right? So we are selecting a term insurance which is more than 61 lakhs, which is one life cover of 1 CR. I've selected till 100 years, and then you can select whichever is comfortable, just reach out to your financial advisor. This is for education or comparison purpose only. So you can see the claim settle, which is a this number you should always look at. So this is better to have, so we can just consider this has a good settlement ratio. Or if you want to go with ICICI, then we'll just take it this as our benchmark. So now this is a monthly premium, so we need to compare it with what you will need to pay. So pay until year 99. So term insurance you have to pay until, if anything happens to you, until that point, or until the end. So you don't get any money back from the term insurance. So whatever premium you are giving, so that goes away, right? So term insurance we are planning, right? So let me just write it here. Term insurance, right? Term insurance was, so how much it was? It is 1900, but let's consider this one on a, which is on a higher side, right? 2827 per month. So from 28 to 99 years per year, how much I'll pay? So basically 2830 into 12 is how much I will pay yearly, into how many years? So basically 99 minus 28 years I have to pay this premium. So basically I'll be paying 24 lakhs of premium. This looks like to be a good value, like a large summation compared to what you are paying here. But just be mindful that this 24 lakhs value is over the period of roughly 99 minus 28 years, right? So yearly you are paying how much? So basically roughly 34,000, right? So now you are paying, let me just value. So now you are paying term insurance in premium. So how much it is? 33,960. So this you will have to pay. So this will be a with negative sign, because you are paying from first year till you are till 99 or 100, right? So you are paying this much term insurance. But now how much money is remaining for the investment for you is basically relative of this. So if I subtract the premium, I won't autofill this because you are investing till here only, right? To make it simple, I'll just make this as a hard value, the same value as second year, 221,419. So every year, so till this year, you are remaining with this value, right? So basically what we'll do is we will invest this value. So now we are addressing the second part, like you want to have a investment tool which is higher than 6% returns, right? So and that this is the amount that you can invest, because this is the amount that is remaining with you. So let me tell you about index funds. So index fund is basically they are the kind of a mutual fund, but they are not. They are just following the top 50 companies in India. So basically, they don't care which are the top 50 companies. They will just go blindly and follow the Nifty index. Uh, so we'll talk more in depth later on. So basically, this is the website to study the Nifty indices parts. And here you can see just what are the returns that Nifty has given. So we'll just go there. And everything is data, guys. Like everything is written. I'm not assuming any numbers or something. So here you can see this is a fact sheet of Nifty 50. Okay. And you can see price of returns. Since inception, it has like given 11.43. So there are two types of return. So what happens is price return and total return. So price return is basically your amount was 100 at year one, and after 10 years it became, let's say, 200. So basically this is the price return. But what happens is basically these 50 companies will give you dividends as well. So those dividends are reinvested, or you can take that those dividends in your bank accounts. So those dividends are added in total returns. So but they are like 2% additional usually, but let's assume that this is our return that we are going to calculate, 11%, which is of course higher than your 6% value, which was the benchmark for this life insurance document. Okay. So this is your index fund returns. We are assuming as 1%. So now how to calculate? So basically, so now at the age of 48, after investing this many values, after investing this many years, so what usually that returns are calculated as future value. Okay, so the formula is FV, open the brackets. So just follow the steps. Rate is basically the rate we are assuming. Number of periods, number of years, how many years we are going to invest is 20, right? And what is the payment amount? So payment amount is recurring value, like what is the amount that we are going to invest. I kept the investment value same from for 20 years. So I just selected F2 value. So now it is asking me for present value. How much value I have invested already. So which is 0, right? And end or beginning. So that is basically at the end of the period, but we have considered January. So it is like a beginning of period. So underscore beginning. I don't know if I'm writing in the beginning. Now I'm closing the bracket. Okay. Like I said, I made a mistake here. Let me just keep it as blank. So this is a dollar sign. Just bear with me. Okay. So basically, if we invest 2.2 lakhs in Nifty, right? Nifty index fund. So based on the 11% past inception returns, so we will have on the uh what is this age? Your age at 48. So there itself you will have 1.4 CR, right? 1.4215,726. So this much amount you will have by yourself. So now you might have asked a question to yourself that you are going to invest this 3 lakhs up to this 99 years, where that amount will come from. So basically at the end of 47th year, with the past performance data, Nifty will have this much amount. So now you can subtract this amount. You can now go back and keep this in the keep it in the Nifty index fund, or you can bring all the value back to FD funds and just take this 3 lakhs amount, keep it uh, aside for term insurance or anything that you can do. You can so there will be two options: keep it in index, Nifty index. Second or safer option will be FD banks, which are already higher than 5%, like we saw. And third option could be savings bank, which is around 4% like we saw. So these are the two options that you will have. And assume if anything happens to you, let's say at this age, so at, let's say something happens at this age 51. So now in our plan, you have two returns. One is Nifty has given you this return, as well as you have term insurance of 1 CR, which we already saw here. So definitely, like, it will make better sense to distribute your this investment into term insurance and index investing. It will give you better returns, and it is giving you like the more assurity of the higher returns if anything is happening to you. Like we discussed here, it was 61 lakhs, and now we selected a policy for 1 CR, right? So we have already selected policy of 1 CR. If anything goes wrong, so you have 1 CR from this, as well as some returns from index investing. Yes, stock market returns are fluctuating, but we will discuss those things later on. But definitely, this insurance returns you will have with you already, right? So this is just a simple calculation to compare. Of course, you will need to reach out to your financial advisors. This will be just for education purpose only, and to teach you like how you can compare your plans. So there are different plans. There is LIC, there is ULIP, there is mutual funds, there are index funds, which I usually do because of the stability compared to mutual funds. And then of course there are term insurance, which you should consider as well. So do your research, reach out to your financial advisors. I hope this was helpful.